Functions of Financial Management, Chapter 1, Lecture 3. This lecture will be a little bit shorter than the other ones. However, it's an extremely important part of financial management, and that is specifically the functions of it. Financial management is concerned with managing an entity's money. Pretty straightforward and simple. But the functions of financial management are kind of broken down a little bit. It's to allocate funds to current and fixed assets, obtain the best mix of financing alternatives. If you just finance different projects by issuing stock all the time, then you might devalue your stock, which might concern your shareholders a little bit. However, if you find a balance between issuing stocks and bonds, and maybe taking out a bank loan, that could greatly change how you're financing your different projects and mixing it up. Develop an appropriate dividend policy within the context of the firm's objectives. Do you give a dividend? Do you roll it back on retained earnings, as Apple has done for several years, or do you pay a constant dividend such as Intel has done every year for a while? So these are just some of the many decisions as financial managers that you would make. This is a nice graph that shows the functions of financial management broken down into a daily task, occasional, and what your ultimate goal is to maximize shareholder wealth. The daily tasks include credit management, inventory control, receipt and disbursement of funds. Occasional financial management is stock issue and bond issue, capital budgeting, and using that for specific projects or for maybe expansion of your business. And then using a dividend decision and dividend policy to decide how are you going to take your earnings. Are you going to roll it back into the company, or are you going to pay it out to your shareholders? And then getting to the bottom line is maximizing that shareholder wealth by having a balance and trade-off between making your company as profitable as possible while still managing risk. And with all the functions of financial management we're using, here are the goals that we're trying to achieve with financial management. The primary goal is the maximization of profit. That's what any business wants to do, is maximize all of their profits. The drawbacks is a change in profit may also represent a change in risk. Credit extension is an example of that we talked about in the previous lecture. If you extend credit, as many banks did during the financial crisis, to many people that might not be credit worthy, if everybody were to pay on time, you would have made lots of money. The problem is if people aren't making the money because of an economic downturn, then they can't pay their bills. And if they can't pay their bills, then you in turn can't be profitable. Another thing is the impossible task of accurately measuring the key variable, which is profit. How do you measure profit? And how is that applicable to the business? And what are you trying to measure specifically? A broader goal is maximizing shareholder wealth, and that is achieving the highest possible value for the firm. That could be measured by several different ways. It could be asset size, it could be market capitalization levels, and it could be overall revenues, or it could be net income. It really is depending on what the shareholders are looking for and what the company management is looking for as well. That is end of Chapter 1, Lecture 3. Please see On-Course Resources, Week 2, Chapter 1, Lecture 4.